Hey everyone, welcome to today's interview with experts. And it is Tuesday, and that means we are back with Jonathan Twomley. How you doing, Jonathan?
I'm great, Michael. Great to be back.
And I forgot to do the 3, 2, 1, but you're a pro. We're good to go. So we took a week off. You went to London with your daughter. Why don't you
Yeah.
catch us up on that, how that went? Hope that was a blast. And did you notice anything about London real estate?
Yeah. Well, first of all, the trip was a blast. It was the first time I'd had a chance to travel with my daughter, just the two of us. Now she's old enough to do that kind of stuff. And it was her first trip to Europe. So we made some great memories, and it was just a fantastic trip. So
Awesome.
super thing to do. And again, this is the power of kind of running your own business and having real estate, because you can just take off and go to London with your kid, and you're not reporting to anybody.
Yep.
You don't have to ask anybody's permission. So this is the benefit of having this kind of freedom, right?
Yeah, absolutely.
I didn't really delve into the London real estate market in any kind of depth because I was too busy having fun with my daughter. But there were a couple of things that just sort of popped up while I was there that I thought were really interesting and people might like to know about. So one thing, so I was watching TV while I was there, watching the English version of HGTV,
Huh.
right? And they have a lot of kind of real estate related commercials on during that show. And one of the things that popped up was this bank that is advertising, like, we will guarantee your mortgage rate for 10 years,
Huh.
right? And this is like a big deal. So the implication of that is that they were like, don't you hate it? Your mortgage rate is bouncing around all the time. You never know what you're going to pay from month to month. And like, oh, well, so they obviously don't have fixed rate mortgages
Yeah.
for buying a house in London. Isn't that interesting? Or I guess in England, not just London, right? So, and maybe all across the UK. So that was, because I think in the United States, we assume that like the 30-year fixed rate
Yeah.
mortgage is the way things are in the world. And it's not that way in the UK. So I just thought that was kind of an interesting difference with real estate over there. And then another difference, which I thought about, so we were staying in a part of London called Chelsea, which is a really nice area in sort of the western side of London, and was walking around and looking at the real estate agents' postings in the local, the windows, and was noticing that a lot of the buildings that were for sale were actually leaseholds, meaning that you don't actually own the land under the building. So you might go and spend, $4 or $5 million on a townhouse in this part of London, and you only own the building. You don't own the land, right? So, in the U.S., we're used to owning, there's some exceptions to this, but basically probably 99% of the buildings in the United States are sitting on land that is owned by the same owner as the building.
Right.
I know in parts of Manhattan, the Rockefeller family owns so much land they basically own most of Midtown Manhattan. And a lot of the buildings there are actually on 99-year leases. But in London, it is extremely common that when you buy a house, you don't own the land underneath it. You're on a 99-year lease of the land. And honestly, I don't know what happened. I have no idea like what happens when the lease is up, if there's some kind of like, if you can get booted out, or if there's some kind of like some kind of law that says they have to release it to you, or how that. I have no idea how that works, but I just think it's interesting for people to understand that every market is different. And if you were to go to London and kind of say, hey, I'm going to go buy real estate in England, you should be ready for the fact that it's very different. You can't get a 30-year fixed rate mortgage. You can't get. I'm not even sure you can get a 30-year mortgage whether it's fixed or not.
Right.
Maybe they were guaranteeing like 10 years of fixed rate because that's all you get is a 10-year mortgage, like a commercial loan in the United States. So I don't know, but it's just every market is different. So be prepared.
And London's not cheap, right? London is typically top 5 most expensive cities.
Yeah, very expensive. But I think those issues are the same kind of everywhere, right? There's not just in London, just the the expense is greater there, but
Hmm.
whether you're on a leasehold or a freehold where you actually own the land underneath, we call that like a fee simple estate, right? In the
Yep.
US, where you've got everything. Over there, it's a freehold. And,
Okay.
um, throughout the country, I think that you have to look into that if you're buying, and understand what it is that you're actually buying and what you
Yeah.
actually own.
Yeah. It's always interesting, seeing a real estate professional such as yourself, kind of travel to other markets, just the things that we pick up on that most folks would miss. So, yeah, I think buying in an expensive market where, again, interest rates are variable, right? Where 10 years, the long term, that's scary, right? Signing up for a 7-figure purchase when interest rates are low, right? Europe is really
Yeah.
low today. Anybody willing to bet they're going to be low 10 years from now? I don't know. So I think that kind of leads to the next topic that you and I have been playing with, Jonathan, and that's the notion of market timing, right? Both the top, the bottom. Is it possible? Kind of all those things. You want to kind of share your thoughts on market timing and where you hear this coming up?
Yeah. So when I sold my entire portfolio
Yep.
last year, I and I was talking about this in my Facebook groups, and talking about this in general. I had a lot of people yelling at me, "You can't time the market. You can't time the market." And at the time, I thought so my response to that was, well, yeah, you can't. It's true. You can't time the market exactly. You'll never know exactly when the top is or exactly when the bottom is, but you can tell, is this a good time to sell or is this a good time to buy? Like those
Yes.
things are pretty obvious. What occurred to me recently, and sort of thinking about this though, was that the people who are screaming about you can't time the market, you can't time the market, so therefore you shouldn't try,
Mm.
are actually trying to time the market, right? Like they're basically saying, I believe that this bull run is going to last long enough to make it safe for me to buy now.
Mm.
So I can build in enough of a margin of safety over time that when it does correct, I'm going to be able to withstand the dip. Or conversely, I should not sell yet because there's more of a run left, which
Sure.
is even more of like they're actually trying to time the market, because what people were telling me is just selling too soon. You're selling too soon.
Mm.
And then they were also accusing me of trying to time the market. I'm like, which is it, right? Am
Yeah.
I, who's trying to time the market? You're just telling me that my timing was bad.
Right.
Um, you know, I think when you're approaching these issues, it sounds overly simplistic to me, but I always fall back on Warren Buffett's, just super pithy advice, which is, be greedy when others are
Yes.
fearful, and be fearful when others are greedy. And
For
I
sure.
think if you live by that motto, yeah, you may miss the absolute tops and you may miss the absolute bottoms. You might miss out on some opportunity for sure.
Hmm.
But in general, over the long term, I think following that advice is going to do well for you,
Yeah.
because it's going to enable you to overcome the fear that's in the market when the bargains are really available, and
Right.
also to resist the frothiness, resist buying at the top when everyone else around you is buying and
Yeah.
telling you that it's great. So I think when you say you can't time the market, like, think about who's saying that and why. I think a
Yeah.
lot of times people are I think a lot of times people what are expressing their own fears about things when they
Hmm.
tell you, "Oh no, the market's still strong. The market's still strong. It's going to go for
Yeah.
a long time." I think they're even almost trying to will that into existence. I
Yeah.
mean, it is strong. Nobody. There's no doubt the market is very strong right now.
Yeah.
But the issue is, like, will it stay strong enough for long enough that if you buy now,
Right.
you're going to be able to ride out whatever comes. If it
Yeah.
happens, if a black swan event happens tomorrow, you're probably not going to make it, right?
Right.
Unless you really bought with very low leverage and you're very conservative, that sort of thing. But if you're out there trying to squeeze out high returns by using high leverage
Mm.
or using interest only debt, or all these other things that people are doing to try to squeeze out a few
Yeah.
extra uh, basis points of return,
Yeah.
um, it could get dicey.
Yeah. I don't know. I believe, Jonathan, probably 6 months ago, I actually mailed you a copy of my book, right? One rental at a time. Did you ever crack it open or not yet?
I have to apologize.
That's okay. That's fine. Because no, it's fine. Because one of the things in there is, so we started in like 02 and we got out of houses in like 07 or 08. So first and foremost, this whole, you can't time the market. I'm not trying to time the market. I made a strategic decision, and we could actually look up the property now, right? I mean, just for example, right? There's a property I bought, the very first one. It's 1818, so 1818 Norris Drive East, 93703. And I would tell your audience to go look, or my audience, or our audience to go look that up on Zillow, right? Hit pause, go look it up, because I wasn't trying to time the market, but you can go look at the transaction history, and this is what the history says. I bought it in December of 02 for 107 grand. It rented for 1,100. Just over 3 years later, I believe, I sold it, technically exchanged it for 264. It still rented for 1,100, right? I wasn't trying to time the market. I was simply making a call that my investment dollar in that asset was marginally not great, and I can use that equity somewhere else. Oh, by the way, the person who bought that ended up losing it, and it retrades 2 years later at 75 grand. So below what I paid.
Yeah.
And it just retraded again in 2019, I believe, for 158.
Wow.
So it is still 30 or 40% below the peak, right? So yes, was I trying to time the market? No, I was simply trying to say that, to your earlier point, right? Everybody was greedy. Everybody was getting countrywide loans, the 2 and 28 teaser loans, liar loans, and I couldn't buy my 9th property. So I'm like, hey, if everybody is going that direction, I'm going to go somewhere else. And I did that 8 times, right? I sold every house in a duplex I owned and exchanged into apartment buildings. So the people that want to tell me I can't time the market, fine. I'm not trying to time the market. But I am saying that, to your point about Warren Buffett, right? When everybody is greedy, I want to get out of the way. And how can I know everybody's greedy? I'm in the market every day. And I can just see the momentum. I talk at real estate meetups 3 or 4 times a month because I want to see what the audience is buying. And you know what they've been buying the last couple of years? Multifamily.
Yeah.
And it has gone from an interest to a wave to a chase. And when people start chasing, I run out of the way.
Well, so just 2 points to make here.
Sure.
So similarly, when I sold everything last year, I wasn't trying to time the market, but I, at the same time, was experiencing the same thing. It had been a while since I saw a property that I thought was valued attractively.
Right.
And so I wasn't buying anything because I couldn't find anything that made sense to me, especially doing syndications where I've got to pay investors. Like if I were just using my own money, it might be a slightly different calculation because I could say to myself, okay, I'm willing to accept a 5% cap rate on these properties because I can't do any better. The problem is when you have to pay investors and investors want 8% and you're buying at 5%, and you've got to make money too, like it becomes very hard to make those numbers work. Right. And on the other hand, though, what was happening was I was getting calls from brokers almost every day asking if I would sell my property.
Right.
And finally, one day I threw out a number to a broker that was really meant to be ridiculous and make them leave me alone.
Right.
It was an FU
Yeah.
number.
Just get off the phone. Here's my number.
Yeah.
Stop it.
And they said, we'll see what our clients say. And the clients came back and said, okay, we'll pay that.
Oh,
and so, I mean, there was a little bit of retrading, but at the end of the day, I sold the properties for way more than I really thought they were worth.
Yeah.
And made my investors very happy. And I didn't have a single investor say, Jonathan, I think you should have held on for another year because maybe you could have made a little bit more money on these properties than you did. No, not a single person said that. What everyone said was, thank you for making me so much money. Right. And I mean, you can think of like so many kind of like, metaphors for this, but it's like, the old Kenny Rogers song, like know when to hold them, know when to fold them, know when to walk away, know when to run. Yeah. Like I'm like running from the table because I was like, you know what I mean? I was like, give me that money. I'm out of here, man.
Right.
And, and the other thing too, like just sort of like, some of these like really old kind of investing aphorisms really make a lot of sense, but there's, bulls and bears make money and pigs get slaughtered. Right.
Bingo.
And I think what you're seeing right now is a lot of piggishness, and the idea of like, I'm going to hold
Yeah.
to get the last cent out of this, or I'm going to like buy because, because this is going to go up forever. And I think so. And your point, what I wanted to go back to too, is your point about multifamily being the flavor of the decade.
Yeah.
Right. It's what, I keep on reading over and over and over again that people are investing in multifamily because they perceive it as being safer than single family houses. They got burned on single family last time, so they've all run into multifamily. Right. And what that does though is like when the whole market shifts into a new asset, it changes whatever was attractive about it before. Now it's not the same asset anymore. Right. And when you're saying the same thing, look, you had that single family that rented for $1,100 and the price doubled and it still rented for $1,100.
Yeah.
The exact same thing has happened in multifamily. Like, sure, rents have gone up. There's no doubt about it.
Sure.
But they have not gone up as fast as pricing has gone up, which is why cap rates are so compressed.
Yeah.
And everyone has convinced themselves that these assets are safe. And as soon as that happens, that there's an issue, because there is no such thing as a safe asset, right? They're all these assets are risky. And the lower the cap rate you pay for them, the riskier they are. And if everybody in the world has convinced themselves that they're safe, that leads to complacency, and complacency is the thing that always precedes a correction and people getting really whacked. So as always, my advice is, I'm not saying don't buy. Yeah. We never say that, but I'm saying you have to go in with your eyes wide open and understand, have some historical perspective about how these assets are traditionally priced over the very long term. Yeah. And you have to decide whether paying a much higher, paying a premium for them now is going to be okay. And you have to make a determination that, either you believe things are different or you don't. And if you do, then, those are famous last words. This time is different.
Yeah. Yeah. I think there's a couple of things that I've actually never shared before about this story. So, and again, it goes back to what's happening today. So the person who bought this property at 263 or 264 or whatever it was, it went up more. So I didn't sell at the absolute peak. I would tell you the peak of the price was probably about 300 or 305. So there was another 10%, maybe 15% left in that house before it rolled over. Yeah. Right. And I'm positive that person who bought it at 264 felt like a genius when that house was worth 300, but he didn't sell. Yeah. And ultimately it retrades at 75. Right. That's a heck of a drop. And the whole time it rented for 1,100. Right. Today, I mean, just in full disclosure, it probably rents for 1,500 or 1,600, but that's 18 years later, 16 years later. And oh, by the way, it's worth 270, 275, something like that. So I'm very happy that we exchanged and moved our equity that was quite frankly false and achieved decades early, right? Because we could have held on, right? We had financing in place. It was fixed rate debt. We could still own that house today and still cash flow today, but I wouldn't be financially free, right?
And so, but you raised a really important point though, right? About if you think, so you bought the house at the right time, right? Yep. If you had held it that whole time, it would have been fine, right? You would have cash flowed this whole time. Yep. You would have built some equity. Maybe you wouldn't have done as well as you did by exchanging when you did, but you would have done well. Oh yeah. Right? But you would have done well because you bought at the right time. Correct. If you had bought at the top, right, you would have been underwater for a long time, and maybe eventually, if you held it long enough, those cash flows would have made up your losses, maybe over time. Sure. But the thing is that your returns are completely dependent on when you buy. right?
Yeah.
And this is something
Exactly.
that uh, people are really overlooking now. I think we've talked about this on a previous call. Like when I got into the business
Hmm.
10 years ago, the mantra was you make money on the buy, right? You
Yeah.
make money when you buy, and you have to buy it right to make money. And you don't hear that anymore because it's very difficult to buy
Yes.
things right,
It's hard to do,
right?
Jonathan. Do you not,
Right.
are you not paying attention?
Yeah. So you don't hear that anymore. Now you
Right.
hear a lot of excuses as to why it doesn't matter what you pay for the property. Multifamily is safe.
Mm,
Rents are going to go up no matter, like it's all this good news. Rents are going to go up forever.
yeah.
The prices, the Fed is going to go negative with interest rates. Like you
Yeah.
hear a lot of reasons why you shouldn't worry about the price you're paying for the asset.
Right.
But there are two things that are really important to keep in mind. One is that, periods of high returns. So when you have long periods of high returns, they're always followed by periods of low returns and vice
Yeah.
versa.
Hmm.
Now, why is that? Why are periods of high returns always followed by periods of low return?
I don't know.
It's very simple, because periods of high returns are the period when people bought low and sold high. And
Ah,
those are followed by periods when people bought high and sold low,
got
right?
it.
And they just follow as night follows the day.
Huh.
So, if you read uh, analysis of like equities right now,
Yeah.
some of the more sophisticated, there are the same types of people in that market as there are in this real estate market, right?
Yeah.
There are the kind of like go go go, it's all great, it's all wonderful, like the Fed's just going to pump up equities even more and we're all going to be fine, even though we're paying these crazy p ratios,
Right.
right? um, and then there are people who are like, hey, wait a minute, I've seen this before.
Yeah.
And you read their more sophisticated analysis and they'll say, dollar cost averaging is BS.
Right.
You make money when you buy the asset is really what controls how much money you make on it, right?
Yeah.
And so going back to our market timing discussion, you have to time the market, right?
Yeah.
Now, you can't time it exactly. You can never call the absolute top or the absolute bottom. You
Right.
only recognize them in hindsight, but you can say stocks are cheap or
Hmm.
stocks are expensive, or real
Right.
estate is cheap or real estate is expensive.
Yeah.
And then what you do with that information is about discipline
Right.
and about your objectives and your kind of your strategies around buying these things. But
Yeah.
you can't look back when you've. But typically, what people do is they look at a period of very high returns, like now, and they project that into the future. They assume that, well, look, Jonathan made 100% returns on his assets,
Right.
so if I buy now, I will too, right?
Yeah.
Where it's the people who look at like Brooklyn real estate and they say, look, those people bought their house and they doubled their money,
Hmm.
and I will too. But what they're not understanding is that when I bought, it is the critical factor, right? And when
Right.
I sold, when those people, the people who doubled their money on their Brooklyn brownstones, bought it when people didn't want to live in Brooklyn and they got them really cheaply, right?
Right.
And or they made 10x on their money is but more likely. Like, they bought in 1980 for $100,000
Right.
in a neighborhood where those things now sell for 3 million, right?
Mm.
Because when they bought, nobody wanted to live there, and
Right.
now everybody wants to live there. They're not going to go from 3 million to 30 million. Like
Right.
that's not
It's not how it works.
it's not going to happen. That's not how it
Yeah.
works. The gentrification has happened already.
Yeah.
Here in this market, the appreciation has happened already.
Right.
So maybe you can force a little more appreciation, but if you do a value add, but you've got to get enough of a bump that you build
Yep.
enough equity cushion that you can survive what's coming, and your
Yeah.
returns are not going to be as good overall because you're going to lose equity, and it's going to take you
Yeah.
time to build it back up again.
And this is something I've been waiting to ask you, because you're in this a lot more than I am. Is the last time when it rolled over, right? When it goes from 300 to 75, the answer was, I'm going to strategically default. Even if I had the income, at
Right.
some point, I was very likely to tell myself, I signed a mortgage. I'm in California, so I agreed to give the property back if I don't pay, right? And you can hit my credit. You're not going to put me in jail. You're not going to do any of these other things. So a lot of people did what was called a strategic default. Okay. So if the new movie is multifamily, I wonder how that unravels, because the equity raise is easier today. The mortgage is probably 65% of debt. Could it fall that much? Maybe, right? I don't know. Does strategic defaults become a thing? Does buying equity positions for pennies on the dollar become a thing? I mean, when this rolls over and is, 50% through the downturn, how does this unravel? I have no idea. I don't know what it looks like.
Yeah, I don't know. I mean, I came in right after it rolled over, so
Okay.
I don't have sort of direct perspective on it, but just from having the research I've done on the markets, I mean, there was about a 30 percentage point correction for multifamily, right?
Okay.
Everyone says, "Oh, it's safe in a recession," right? But what happened? What happened was there was about a 30% correction before the big, from the top to the bottom, before this big boom happened, and I think historically, like that's, or maybe it was 40 points. I think historically it's like 25 to 30 points, and then, but it was really big one, so there was like a 40-point
makes
correction.
Sense. All right.
And I think what happened was actually a lot of people did walk away from those assets. And that is why now when you buy multifamily, you have to have all these bad boy carve outs, even though it's non-recourse, because the banks wanted to, basically they want to stop the strategic defaults. Right. So a lot of banks got burned before with people just walking away. And handing them back an asset that they just basically like,
here you go.
Here you go.
Here's the keys. Lock it up when you're done.
Yeah, we did half our renovation. You can't even rent this thing out. Like, it's just, we've destroyed a lot of your money. Here you go. So now with these bad boy carve outs, not being able to pay is one thing, but if you could pay but you just walked, I think that would probably trigger one of the carve outs, and it would become personal recourse to you. So I think it's going to be tougher to do that. On the other hand, I thought you were asking a different question, which was like, if you're still making money, should you walk away? And I would actually say that if you are still making, like, you're not losing money out of pocket, right? You're still actually making money on the asset month to month. Why would you walk away from it?
You wouldn't. Yeah, if you're making money on the asset, you wouldn't walk away. But I guess what I saw is, like, just take the guy who bought my building, right? So I'm going to assume he had a tech job. I actually don't know who it is, obviously. No. But let's assume he had an income that could have supported the asset, but he just got tired of reaching in his bank account and paying.
That's different. Yeah.
Right. Yeah. Right. So he could theoretically afford to pay it, but he's like, I'm not taking $500 out of my savings account every month to pay for this asset that's worth 15% of what I paid for it.
So is he like, in that case, do you think that he was actually betting on the speculation, and that
no question,
the rents weren't covering his mortgage?
No. He bought a negative. Yeah. Again, of the 7 or 8 people, every asset I sold in 08 or 07, whatever it was, came back. I watched it, right? 2 years later.
So they were bought negative cash flow.
Yeah. They bought negative cash flow, or they were bought with a teaser loan, right? Bank of America was giving out 0.9% interest for 2 years, and then would reset it year 2 to 6 point whatever. And then they ran the mortgage on the 0.9% interest rate. So when it recast, it all blows up, right? So it's just dumb loans, but that happened.
I mean, I think that this is, one of the things that I'm the only one who says this, but I mean, I think this is a good illustration of why people should always invest for cash flow, and not invest for appreciation, because the cash flow is something, I mean, it's not 100% guaranteed. If you lose your tenant and it's a bad recession, you can't get another tenant, that's the risk you take. But, the asset appreciation can either not happen, or it can all disappear and you can go negative
quick.
And so if you're and I've seen people do this before, like people who told me a couple of years ago, California real estate never goes down.
Oh,
So
you know how many times I
therefore,
heard that?
I'm safe to buy at any price because it's always going to go up. And I'm like,
Uh,
that's just not true. Like I've seen it go down before, and I'm not even in California. And like, and at the same time, it's, you know, like what makes you think that this time is different, that it's not going to go down this time when you're
yeah.
paying these prices. But I remember when I was still a lawyer, but I was starting to get really interested in real estate. I remember talking to one of my colleagues at work who told me that she and her husband had bought this condo as an investment in the city. And I asked, oh, well, how much are you guys making every month on the condo? And she's like, oh, we're not making money. We're, you know, our tenant is subsidizing the mortgage,
Yeah.
and, you know, we're paying the balance of the mortgage. But, you know, when we sell it, we're going to make up the appreciation. And, you know, this was like 2007
Yeah.
when she said this. And then the crash happened. Now, you know, she might have been okay if she was able to continue to hold that property because of what happened subsequently.
Mm-hmm.
But at the time, like, nobody could have predicted that every central bank in the world was going to just start pumping cheap money into the system, and that, like, you know, Russians were going to start laundering money in New York City by buying apartments, you know, like
Yeah.
all this kind of stuff that happened
Yeah.
subsequently that, you know, quickly boosted the price of apartments back again,
Mm-hmm.
and started increased rents as well. So, you know, I hope she held on to that property, because she probably is doing fine now if she did.
Right.
But at the time, like, the idea that, like, you're betting on appreciation, and you're paying out of pocket you're literally losing money every month because you're taking this bet on
Yeah.
appreciation
On purpose.
on purpose.
Yeah.
Yeah. In New York, it worked out, you know, where you are, it didn't for those folks, right?
No.
Because they're still underwater if they bought at the time.
Yeah. I mean, still underwater by the tune of, 30%. And again,
Yeah.
this is very single family oriented. Just if, I mean, full disclosure, multifamily in Fresno is up from that time frame. It's probably up. I think one of your questions, I think, was what's going on in the real estate market? Is it above,
Oh, that was the one.
no,
So actually, somebody in my group
oh,
asked that
somebody,
question.
your group, but
Yeah.
somebody else.
Yeah.
So full disclosure, right? Fresno multifamily is up, I think 50 or 60% from the '08 peak because multifamily was underappreciated and rents are up, right? So it makes sense. But single family homes are 30 or 40% below where they were, right? Fresno's not back to the peak. It's crazy.
So you raise another interesting point inadvertently here, probably, but when you were talking about multifamily was depressed before,
Mm-hmm.
right?
Yeah.
This is also true. See, if you look at so occupancy rates at the peak of the housing bubble in multifamily were in the low 90s.
Oh, for
right?
sure. It was a horrible time to be a landlord.
Yeah, I mean, it wasn't horrible. If you bought the property, if you priced it right, you were buying assets really cheap, right?
Yeah.
So, but if you had bought them, you know, if you had bought them on the expectation of 95, 96, and you were down in 90, you were hurting, right? Unless you bought it a long time
It was the
ago.
only time I ever had move-in specials to the point, right? It was an odd time because everybody who had a pulse could take first month deposit and rent and move into a house for less. It was crazy.
I remember renting an apartment in Manhattan around that same time, and they were giving away 2 months free rent.
Yeah.
And paying all the broker fees because everybody was trying to buy a house and nobody was renting.
Yeah.
And in New York, that meant 5% occupancy as opposed to the 3 that they typically have. But the you know, the point though is that when people say, I hear this all the time, multifamily does well in recessions because of what happened last time. What they're failing to understand is that multifamily assets going into the peak of the bubble, even though there was a big price spike, they were not trading at the kind of premiums that they're trading at today.
Not even close.
Because occupancy was lower, right? Occupancy was like 90, 91%
for sure
nationally, right?
Yeah.
At the time. So that means that if you're assuming that the traditional long-term, you know, underwriting mark is 95% occupancy for multifamily, for large multifamily anyway, you were already buying it at a discount to intrinsic value by buying at that lower occupancy, right? So heading into the recession, people had bought stuff, especially if they bought it a couple of years before the peak, right? if they bought it at the peak, a lot of people still got hurt. But if they bought it
early,
a couple of years before that, and they were, their occupancy was lower, they're buying at higher cap rates with lower occupancy. So think about that. Buying at higher cap rates at lower occupancy, that means that you're getting a lot of free equity in that property, right?
Mm-hmm.
When it goes back to 95% occupancy.
Yep.
And then if you get some cap rate compression, and that's what happened, right?
Yep.
So people made a lot of money when this flood of people came out of, it's just so much like, there were more people buying houses than historically had ever happened. There's like a 5% additional, all these free tease rates, all this stuff drove 5% of the population of the United States who had no business buying a house and had never done it before into housing, into home ownership. So we were at an all-time high peak of home ownership, right? And so naturally, when that thing went kablooey, those people all had to go back to where they came from.
Yep.
It wasn't because like multifamily is so attractive or does so well in a recession. It was like a particular moment in time with a particular circumstance that led to that, multifamily does well in recessions. And I remember talking to my property manager because after hearing this enough, I was like, am I the crazy one? Like, this doesn't make any sense. I went to him, and this is a guy who's been in the business for 35 years, is on the board of the National Apartments Association. And I said to him, Mike, just give it to me straight. What happens in a recession with multifamily? And he just looked at me, your occupancy goes down. Like, it was just like,
duh.
It was like, come on, what are you asking me this question for? But I was like, look, I
gotta know.
Right? I gotta like confirm. That's what I assume, but I gotta confirm this with you because I'm hearing all these people go around saying that multifamily is recession proof. And,
Yeah. So I've owned it through 2 recessions. I've owned multifamily through 2 recessions. Now, admittedly, it's small, right? The biggest thing I own is 20 units. So it is what it is. But I could tell you that my tenants fight a lot harder to stay in houses than they do apartments. My effective occupancy goes down in recessions. And I have a couple that I can point at that show that. Because people in houses want to stay and they'll just ask family to move in.
Yeah.
Right. They'll rent out a bedroom because they want the backyard and all this other stuff. So multifamily does not do well in a recession. Unemployment will eventually go from 3.5 to something much higher. Cap rates will eventually expand. And what I'm looking for is, okay, when, values come down and cap rates go up, what's going to happen at refi time? And that is, do people walk away? Do banks go extend and pretend?
I think there'll probably be a lot of extend and pretend
probably
going on because the lenders won't want to foreclose.
No, they won't want them. Yeah.
And they're going to wind up just kind of kicking the can down the road. But if they're with a true refi where you've got to go in at you're only going to refi 70% of the value, not 75, like a purchase.
65, 70,
yeah. And so you got to come up, and you're hopefully going to make that up anyway because you've had appreciation. But if you've had equity loss, now just to pay back that previous balloon payment.
Yep. Equity raise.
You don't have the proceeds. Yeah. You got to go either take money out of your pocket or go to your investors. And frankly, look, if you're a syndicator, there's a recession and, your investors are either scared or they have lost money in the stock market or they've lost a job. And now you're going to them with a capital call. You're going to have investors who are like, you know what?
Done.
I'm out. Like, go do your best, good luck to you, but I've got no money. I've got no money for you.
Yeah. So that's why I am a pretty firm believer that something I'm going to have to figure out how to do is to buy equity positions for pennies. Because I think that's exactly what's going to happen.
Yeah. I mean, it's going to happen. I mean, there are some businesses out there doing it already that buy LP positions at a discount.
It's going to be a thing for sure.
Yeah. I think it'll be a thing again. And I think that, the other thing is going to be non-performing loans also.
Yeah, absolutely.
Right? So,
very, very cool.
Yeah.
Well, Jonathan, this is always so much fun. Welcome back. I'm glad you were able to make some memories with your daughter. That is father-daughter time is awesome. I love it every chance I get. And we will do this again next week.
Absolutely.
All right, buddy.
See you then.
Thank you. Yep.
Take care.